Hey, welcome to this month's webinar. My name is Matt Benson. I run a financial planning firm in Chandler called Sonmore Financial. We're going to talk this month about Roth conversions. So, Roth conversions, a lot of people probably are familiar with at least Roth accounts. Money goes into a Roth account, it grows tax-free, comes out tax-free. Um, and many are familiar with the concept of what Roth conversions are. I'm going to talk through today, I'm going to go through in detail, like what a Roth conversion is. I'm not going to assume that you know what it is. I'll make sure we're on the same page. And I'm going to talk through why you would do it, what are the advantages, and then how do you determine how much you would do or if you're a good candidate for Roth conversions. So before we dive in here, I want to talk first about what a Roth conversion is. So I'm going to, oh, do I have the right color here? Let's see. No, red. Hold on a sec. All right, there we go. Now we're good. All right, so let's talk about what a Roth conversion is. So we've got, for retirement accounts, we're going to say we've got basically two types of accounts. We've got pre-tax and we've got Roth. So the difference between these two is not what you can invest in. You can invest in the same thing in both, but simply how they're taxed. Pre-tax, this could be like your 401k or an IRA. When you put money in, you get a tax shelter around that money. That money's tax, you get a tax deduction. So if you make $100,000 and you put, 10,000 bucks into your 401k, your W-2 makes it look like you made 90,000, right? So money is tax deduction when it goes in. It's tax deferred growth, and then when you take it out, this money comes out and it's taxable. This is taxed at ordinary income, or OI, if you want to sound cool at a party. Roth, on the other hand, we're saying I'll pay the tax today. So if you made contribution to like a Roth 401k, put 10,000 bucks in, you're still taxed as if you made $100,000 in the example I used before. So yeah, money goes in after tax, then grows tax free, and then comes out tax free. So understanding the difference between those is important here. One's not necessarily better than the other. It's one you're going to pay tax later, one you're going to pay tax now. A Roth conversion is when you have money at the growth stage right here in your IRA and you say, I want to move this money to my Roth IRA. Well, when you do that, this is taxable. So why would you do that? The reason you would do that, I'll sometimes explain this and kind of it's really not way more complicated than a kindergarten level math problem here. Um, it is your sentiment in doing something like this would be that you believe that the tax rate today, let's say for this person, let's say it were 22%, you believe that that is less than the unknown tax rate of the future. If you didn't believe that was true, then you probably there are other motives to do a conversion, which I'll talk about. But I would say this is the primary one, right? What we're trying to do when we're doing a conversion is we're trying to pay tax at the lowest rate that we can, and or give ourselves more flexibility here. So imagine if this is charting your income over time here, this graph, and say while you're working, your income kind of slowly rises, and then it drops maybe when you retire, and then it slowly rises once you start drawing Social Security and have required minimum distributions and such. Kind of the primo window where we like to do conversions is this window right here, shortly after you retire, um, and before all of your income turns on. That's typically the window where you can do the largest conversions for a typical retiree. We call those the gap years, and you can see why, because there's a gap in income during that window there. So that is kind of what Roth conversions are. I'm going to talk through now. I'm going to talk through what are the benefits, why you would do a Roth conversion. So the first one I'm going to talk about is liquidity. So I'd say there's really kind of four main reasons that you might do it. There may be others, but liquidity is one. And then the other would be kind of a tax play here, reducing future RMD, managing, whoopsie, oh no, whoopsie. All right. managing, um, oops, there we go. Uh, all right, here we go. Managing RMD, or sorry, managing IRMAA. So once you're 65 and you have to start paying IRMAA. And then kind of the last one would be legacy or inheritance. So I'm going to talk through each one of these here. So the first one, I would say, I'd say that typically the way that we solve for it prioritizes reducing future required minimum distributions and then managing IRMAA. However, I would say the biggest motive of why somebody would do a Roth conversion is future liquidity. So for a lot of clients, you may end up having a large expense in the future. Maybe you want to buy a car. Maybe you want to do a home remodel. Maybe you want to purchase a second home, whatever. I hope it's for something cool like buying an RV, but it also could be for something boring like, funding long-term care. And if you have a big expense like that, say you had a $150,000 expense and the only assets you had were pre-tax, well, if your income were already high and you have to take a $150,000 distribution, you may end up just getting bashed over the head and say, hey, well, I don't have any other options. I guess I'll just pay the tax at whatever the rates are at that time, even if that accelerates me into a higher bracket. So, uh, a lot of times what we'll say is, hey, let's convert maybe 40, $50,000 a year, and I'll show you kind of how we solve for that. And then just balloon, accumulate money in that Roth account, and then you don't know what expense that you may have, 7, 8, 10 years down the road, but then it gives you liquidity that you can go purchase something, and you have money that you can access tax free. So that would I say is kind of the primary motive for a lot of people here. The second one would be reducing future RMDs. I already talked about that a little bit on the previous one there, right? If your income is kind of slowly rises over time, you really have two things that, I used the example before of saying, hey, today's tax bracket, let's say hypothetically we're 22%, and we're comparing that against the unknown tax rate of the future. Well, you really have two things that we need to know or factor in to determine what the future tax rate is. One, what are future tax rates as a whole? We're not going to get that one right. We're not going to get that one right. But usually when we do projections, um, we like to assume that the current tax rates are what are going to be for the future, because if we make any other assumption, it's going to be, probably largely wrong. Though I would say the tax environment that we sit in right now is it's pretty close to 30-year lows for income taxes. So, if we're at lows, and you look at like our fiscal deficit as a country, that either means we got to curb spending or increase revenue in order to kind of make that gap shorten. So even if your income were flat, for a lot of people, they're kind of pessimistic about future income tax rates being lower than they are today. But for a lot of our retiree clients, they not only have that, but we also believe that, hey, their income's here today, but their income's going to be higher in the future because they're going to have to start taking larger required minimum distributions. So that's kind of the tax play. The other one here, IRMAA. So once you turn 65, you have what they call IRMAA tax, and it's if you are once you're on Medicare, you have your Part B premium. Your base premium uh, is about $185 a month, and if you end up having to pay more than that, if your income is higher, then you end up paying what they call an IRMAA premium or IRMAA tax. So like for 2025, the first bracket, if you're married filing jointly, modified adjusted gross income could be up to $212,000. 212. If you were over that, your premium went from $185 to $259. and that's per month per person. So if you're a married couple, again, not a huge deal, but if you go over this, like if say if you got a pension and Social Security, and then you take normal IRA distributions, say if your income was 215,000, not 212, well, that 3,000 overage cost you 75 bucks times 12 times 2 if you're married costs you, almost 50% tax, or a little more than that, 750 a person, let's say, or 800, 900 a person, let's say. So definitely something that we want to take into account here. And then the last one would be legacy or inheritance here. This is again kind of a little bit of a tax play here. Um, so if you're going to pass a lot of money on to the next generation, if your tax is less than what you think if if you have kids that are going to inherit money and they're high earners, it might be cheaper tax wise to for you as the parents to pay the tax than to pass it on to your kids that are high earners. Um, and or you could say, well, if they get the money, then whatever they get. They don't have to worry about paying any tax on that. They're also like if you have a very large estate, there can be some motive from a kind of estate tax standpoint or estate planning standpoint to do Roth conversions, because then it lowers the size of the estate, which would reduce it. Again, it doesn't apply to a lot of people because you have to have a really large estate, with the exemption amount being 15 million per person right now. But if you do have that, if you're a married couple over 30 million, or just an individual over 15 million, having that in your back pocket as a way that you can, reduce your estate, something worth considering. All right, so the last thing I'm going to talk about here is kind of strategy. So I'm going to kind of think through it in two ways here. One, I'm going to say macro strategy. So this is kind of big picture. And I say tax plan, macro tax plan. So this is where we're like when we're meeting with clients, we're going through and we're doing a 20-year tax projection. Right. And the only thing I know when we do a 20-year projection is that it's going to be wrong, but we're just trying to keep it as close to not wrong as possible. Right. And that helps inform if I can look to the future and go, hey, if we don't do anything different 10 years from now, this is what we think our taxes are going to look like. That helps to inform today, what do we do? Right. That helps to answer the question of this one right here. If we're in the 22% tax bracket right now, is 22% less than or greater than the unknown tax rate of the future, right? Well, if I can do a 10 or 15-year tax projection, I can start to get an idea of what someone's income is going to look like. And then if we just assume tax brackets are somewhat similar, now we can start to make sense of this, and we can go, yeah, I think that 22% is less than the unknown rate. Or if it's greater than, then you wouldn't really do any conversions, right? So that helps to inform, do we do any conversions at any given point in time? The micro tax plan is looking at this every single year and saying, okay, so my income right now, so my taxable income right now is, say, sorry, I'm pulling up my cheat sheet here. Say is $140,000, right? And the top of the 22% tax bracket is it's a little over 205,000. It's almost 210,000, let's say. Um, so if we thought it was a good idea to pay tax at 22%, and again, the motive in this is a little odd, right? Because normally you've been like, oh, I don't want to pay that much tax, right? Your motive in doing a Roth conversion is you're saying, I get to pay, I can pay tax today or I can pay tax later, or whatever, where is it cheaper, right? And that's why you would do a conversion, is because you think it's cheaper to pay the tax today. So in this scenario, if someone's tax projection we ran had them at 140, and then the top of the bracket was 210, then we may look and go, okay, well, you could do about $70,000 as a conversion or less, right? Conversion and or distribution. So if they said, hey, well, I want to go buy a car this year. Okay, well, then oftentimes we'll say, well, let's take however much we need to buy a car, and then whatever's left we would do a conversion with. There's other things to consider in here too, right? Like, so I'm only this one here, I was just looking at tax brackets, but when we do our tax projections, we're also looking at those IRMAA brackets, right? And those show up on our tax illustrations, as we'll see the IRMAA brackets, and then we also see the tax brackets and where those increase. So it's very, very helpful to be able to see those visuals. Helps to inform, so that you can mitigate how much tax you pay over your lifetime, give you more liquidity, and helps you preserve a larger legacy as well. So with that, I'll go ahead and wrap up here. I think, again, the things that are most important in this, the reasons that you would consider a conversion, going back here, liquidity, create extra liquidity, reduce RMD, or reduce RMD and pay less tax, manage your IRMAA premiums, create a larger legacy. The ways that you would do it, have a big tax plan, and then have a micro tax plan for that individual year. So anyways, hope that you enjoyed watching this and learning. And if you have any questions, feel free to reach out.